Good afternoon, ladies and gentlemen, and welcome to the second in our CEP and GenLess webinars, which are going to help you reduce your carbon, save energy costs, and become more efficient and more productive when it comes to energy use. Today, we are joined by Shaun Hayward. Shaun is with Smart Power, and he will be talking about procurement. So the focus is very much on making sure you get the best deals and making sure that you're getting good value for money when you're actually coming to look at purchasing your energy. So that's enough from me, I think, for today. I may say bye-bye later on, but for the moment, I'm going to hand you over to Shaun. And if you'll bear with me just briefly, please, while I hand over the presentation rights. Shaun, you now have control of the system, and I shall switch off my camera. Oh, before I leave, if people wish to submit questions, please do so as we go through. When it comes to an appropriate spot to interject, I'll be monitoring the questions, and I'll interject and invite you to ask those questions to Shaun. So enough from me, and over to you, Shaun.
Thanks, Mike. Thanks everyone for dialing in. You won't have to look at me for too much longer. I will share my screen and we'll bring up the PowerPoint, and hopefully from there you can see what we're actually talking about. Energy procurement. I will try and cover off electricity, to some degree natural gas and LPG. I apologise, it will be slightly electricity centric, and also it's probably going to be a little bit referencing to Auckland occasionally, but it does cover the whole of New Zealand, and I will try where I can to cover off all three sources. In terms of who we are, you get to see who we are there. I've been in the industry since 1996, and I've handled procurement for electricity, natural gas and LPG and coal since 2008.
Shaun, sorry to jump in quite so early. I don't think we have your slides.
Can you still see me?
We can see you, and we can now see your slides. Thank you.
Ah, excellent. I presume you can still see them. We offer services in Australia in terms of what we actually do, but also in terms of that we have 4 employees working on procurement in terms of services, and plus myself, I predominantly do the gas side of things. Glenn predominantly does network, and we have Steve working for us in Australia on the energy procurement aspect as well. I guess the procurement aspect would still work for Australia, although it's not actually referenced specifically in this report. We do everything through 3 brands. Smart Power handles all our energy management clients. Group Energy is something where we bundle together a lot of franchise clients and smaller clients, and we put them out to market as one group. And on that aspect, the smaller clients, you will actually occasionally see Group Energy purchase appear as a fee on the invoice, on the retailer invoice if you're part of that activity. But generally, we're an independent energy management consultancy. That means we don't get any commissions or any incentives from retailers to actually give them any work. I'll try and get through this reasonably quickly. Probably a little bit upsetting for a few people on the first slide. It says procurement for energy is mostly about price. That is largely correct. The question for most people is how much is it about price? We're often told by the retailers that the reason they change prices is that their indices have gone up. That could be EMS trade point for natural gas. That could be the Saudi AMCO price for LPG, it's an international traded, or the ASX for electricity pricing. And these prices change quite a bit, but a lot of the conversation is about why are prices so different if everyone's pricing off the ASX? I guess my first statement is that not everyone prices off the ASX. The ASX trades at 2 particular points in New Zealand. Where am I? I've just gone one slide too far. Sorry, why is it about price? The ASX trades off two nodal points in New Zealand, predominantly Auckland and just south of Christchurch. And there is 6 places where you can transact with FTRs and shift that load around the country. Retailers dealing at, or trying to handle 59 grid injection points and 226 grid exit points. That means that prices around the country vary quite a bit. And whilst they may be centrally located in terms of a trading point, our customers are spread across New Zealand. Retailers will hedge through different methodologies. They will use their own generation. They will trade with others in terms of over-the-counter trades, and they will actually trade daily on the Australian Stock Exchange for electricity. And for natural gas, they'll be trading on EMS Trade Point, which generally has one settlement location. But the point is, electricity retailers, much like consumers, are buying things at different times all over the place, and it's can be a little bit difficult to work out what it is they've actually transacted and how they're using that to pass on their final cost to consumer. It does
Shaun,
also mean that,
sorry again, we don't seem to have your slides moving on at the moment. We still have your first slide. So we did see a couple more there.
you can see them now.
We're now looking at what makes up an energy offer. Is that where we're supposed to be?
Yep, second point.
Perfect, thank you.
Yeah, so we covered off the ASX, we covered off retailers will hedge using their own generation or transacting with each other. What I was going to say about that is it does mean that whilst gentailers or retailers and generation companies will predominantly be sustainable or will have their own generation sources, they do also interact with each other, and they're covering off a lot of their risk in terms of supplying customers by contracting with generators either closer to the location or with different variability of supply. So working out, just saying that the ASX has moved is not a relative reason for understanding why the contract offers have moved. Retailers will also change their focus time to time in different market segments and client sizes and profiles and the like. So at different times, and especially at the moment, there's quite a few changes in terms of where retailers think their customers are going to be coming from, whether it's the industrial commercial segment or whether it's the small mass market commercial guys or whether it's households. And these things change. And part of the procurement aspect is picking up what retailers are focusing on and also what term they're looking at in terms of what they can contract for. The other options, I guess, is that retailers can buy on the spot market, as can consumers. So they don't have to cover off the contract they're supplying to consumers. They can self-hedge or self-insure. And different contract types that I'll offer, which is something I'll cover off probably later on in the presentations, different contracts, but also different terms. So 1 year, 2 years, 3 years, and force majeure clauses and those kind of things go into it. And finally, there's the margin that they expect. So different size customers will get different margins, different locations in New Zealand will get different margins. People across New Zealand with multiple sites will get different margins to perhaps someone in a general regional location. Procurement, it's mostly about price. The question really for a lot of clients is how much is it about the price? We're certainly getting a bit more feedback from clients that it's also about sustainability, but a lot of the stuff they actually have in there is also just about being a retailer. So I guess the first part where procurement actually offers some help to the consumers and the clients is the market understanding and how the market works, the role the retailers play in terms of fixing the price, the role generators play in terms of generating the electricity and how they interact and provide those prices to the market, the role network companies make, and so forth. it's not really the point of this presentation to tell you how the market works. It's more to deal with the procurement strategy and the procurement analysis aspects of it.
Shaun, we actually have a question coming in already, which is always a great sign, of course. We've got a question.
Is one of them, how do I use a PowerPoint?
No. It's a question from Eric. So what I'm going to do for these questions is I'm going to open up the microphones of the questioner and enable them to ask their question directly, so that in case there's a follow-up to it. So Eric, I'm about to open your microphone. Would you like to ask your question, please?
Hi, Shaun. This is Eric calling from PowerNet in Chicago.
Hi.
Yeah, so my question is that you've mentioned that apart from retailers are able to buy energy from the spot market, that customers are able to buy energy from the spot market as well. I'm just wondering, how do we actually enter that game? Is there any specific requirements?
Well, there's two things. One, you could ring me, and I could probably arrange it for you. But effectively, most retailers these days offer a billing service that links the energy you consume to the spot price available from the market. It is something I'll cover off with contract types a little bit later on, but one of the things I have around that slide is effectively everyone buys on spot, just that they get to offset that volatility in cost by taking a fixed price contract with a retailer. So how you do it, you just ring up the retailer and say, I'd like to be on spot. As long as you don't have an existing contract in place, they will talk you through it. And there are a number of things they're going to have to cover off with you. When do you consider going on spot? Well, I'll bring the presentation back up to speed. Typically, we recommend starting the contract renewal process about 6 months before the current contract expires. I mean, we monitor the market every single day, and so it goes up and down for a number of reasons. But within that, we will contact our clients 6 months before the contract expires and say, hey, your contract's coming up, market's done this since the last time we actually did it. We'll be in touch to discuss your plans about getting a new contract in place. When we start that conversation with them, probably one of the things I do actually like sending them is this slide, the first two graphs really. If it's electricity, it's the top one. If it's gas, it's the bottom one. The top one's from the Electricity Authority EMI website, and it's the historical risk curves. It says a number of things. One is it says what this current storage level for hydro generation is at the time of actually printing out the graph. It says what it is in relation to where it normally is. And it also does one other thing, and it just highlights in that the blue line crosses the grey curve, that smooth grey solid line, pretty much September, October each year. I think there's 2016 it didn't, but you'll notice even when it's below the curve, it comes back up through that at that last point, and when it's above that point, it comes through it, it comes down through it. The reason for that is that that's the point that the generators or the hydro generators like to drop the lake levels to allow for the spring rains and the snowmelt to fill the lakes. And they're expecting those lakes to fill and to probably be near the peak capacity just about February, March kind of time. It makes a difference in the market in that if you are below that curve, they're desperately trying to get to hold the water back and get the storage up. So you'll see prices rise, usually when the blue line's below the grey curve, and when it's above, you'll notice it fills up a lot quicker than it drains out, and that's just because it fills up from the storms, which are a bit harder to predict, and then the generators will eke out that water as they see the need to dispatch to meet demand, but also on the expectation of future storms. The gas one has a volume. The orange line is actually the price. When the price goes to zero, it's not actually that the price of gas was zero, it's that there was no trades that day. And certainly you can see the volatility that's come into the gas market since the end of 2018 and what that's done to the 90-day moving average price. There's nothing special about the 90-day moving average price. It was just gave an indication of how the market's moved from about $5 to $10. Now it's coming back down. But I mean, these graphs go hand in hand in that the electricity market is built off the gas market as well, with gas being a major contributor to generation sources. But also to go with the electricity graph, you'll need the Met Service report to know what's actually happening in terms of future weather forecasts. And I also use Meridian Snowpack. So September, October time, definitely have a look at how much snow there is. As you come through winter, definitely track how much snow there is. That'll give you an idea of what's going to melt as it comes into the lakes, and definitely forecast for the summer. And we've had very dry summers recently. All those numbers there come into what most people are probably aware of as the ASX, or the Australian Stock Exchange, and this gives you an idea of what the quarterly prices were for 3-year periods as at each of those dates. And you'll notice each of those dates start with the 6th of the month and then the year. That's not actually the day that I actually wrote it down, it's just how I actually record it. But generally around the first week, I take a reading of what the actual market is. And this really just says to me that at any particular time, their view of the market has changed. If you were able to pick the market at the bottom of every single one of those trades, you'd have paid around $60. If you wanted to, or if you're a retailer or a generator and you want to sell, and you could pick at the highest point of the market for each of those quarters, off each of those trading periods, you'd probably have received about $120. The average is around $80 to $85 mark, and the average for the spot price for the period 2013 to up until today is around the $85 mark as well. So it gives you an idea that the ASX, to some degree, on average, is indicative of the spot prices. You can also see the effect that 2018 had. So whilst everyone's very smart about predicting and knowing storage and knowing gas levels and predicting solar and all the rest of those things, unexpected events have major impacts to the electricity market. And I'll cover this off with a word I'll use, with scarcity of supply. But as of 2018, you can see what actually happened to the market. Those curves jump up through the roof, and they have somewhat settled down. So the solid black line is the price as at today. I know I've got it in there as the 6th of May, but it's the price as at today. Probably out of all of those things, none of those lines actually line up with where it is at the moment, and none of them actually lined up with what the resulting spot price was. It's just a forward view, and to some degree, what we're trying to do is time the market as to when that ASX is at its lowest point. Why does it move around so much? You can tell I actually went to a presentation on points, and they said use graphs give 1,000 words. What this graph actually says is that at any given point, it happens to be April 2010, but at any given point, even today, there are inflow sequences and dispatch sequences. And the question is, as at today, what's it going to do? Is it going to rain more than one of the highest rainfall periods, and it's going to keep raining, and they're going to slowly try and lower that lake through dispatch mechanisms? Or is it not going to rain and the lake volume is going to drop massively? Or is it going to be somewhere in the middle and comes around the average? The retailers are checking this daily, or certainly weekly, in terms of what their forecasts and their prices are, and they're bundling the expectation of rainfall along with the expectation of gas supply, along with the expectation of wind forecasts. And it gives you an idea of why it's quite hard to forecast electricity prices and forecast spot prices, and why electricity prices can change relatively dramatically. You can see how big a swing it is even in the first month, between 2,000 and 3,500 gigawatt hours of load could be available in the space of 4 weeks. So this graph, it really just actually says one of these lines is probably what's going to happen. It's just the trick is trying to guess which one it actually is. What I do to track the market, and in terms of the procurement side of knowing when to go to market, is I track what the 12-month average price is for the current year, for next year, the year after, and the year after that. That red line, at any point along the bottom of that graph, you can see what the price was for the 12-month term on the red line. And again, you can see around 2018, you can see where the 12-month prices went from $70 for the coming year up to $190. And really what you're trying to do is avoid going to the market at the $190 price and go to the market as often as you can and buy as much as you can at the $70 price. That's a combination of two things. As I said, we try and go to the market 6 months before the contract expires. The current events up until the start of April were amongst the highest we'd seen in a very long time, and certainly the highest we've seen since 2008. It's very hard to actually say that that's lasted 18 months. And so going to the market 6 months beforehand was probably not going to protect you. You needed to lock in everything you possibly could 2 years ago. And that's where some people will say, you know, going to the market more regularly and getting a more average price is better. A more active trader would tell you that you're able to pick the market and, you know, inflows like this. But a combination of those two things is really what you're looking for. To actually trigger that contract time, or when to actually go to the market, you need to consider the second thing I had on the slide, which was what term do you recommend to your customers? Generally, when we start talking to customers, we'll have a view of what the new generation options are for the next 12 months up to 5 years. We call that kind of the medium term. The short term is what's going on in the hydro market. So that gives us a timing sometime within that 6 months prior to it. But once you actually make it the decision, it's a little bit chicken and egg. How long do you contract for so that it comes up in a period where you expect those prices to be lower? To do that, you've got to understand your client's needs. Companies have policies about how long they can contract for, and I've listed some there that perhaps have shorter term contracting periods than New Zealand's kind of average. New Zealand's average being 3 years, or most frequently 3 years. Some companies will only contract for 12-month periods. The other one you need to consider when it actually, the other one is whether or not they're going to open or close that site. So some contracts have termination fees, and especially financial contracts, if you're dealing with those contracts can survive the site actually shutting down based on the settlement of it. So I'll explain a little bit what that financial contract is shortly. The other thing to actually consider is what are the retailers actually going to offer you in terms of specifying a term for your client. So if you've gone to market, you know what their policy is, you know what the new generation is, you know what storage is at the moment, you think it's a pretty good time, you're going to get some offers from retailers varying between 12 months up to 5 years. Each of those retailers will be trying to fit your volume into their portfolio. And some of them will have a view that they've got new generation coming on board in a couple of years' time, and they'll be looking for 5-year contracts. Some of them will have excess amount of water at a particular time, and they'll be looking for 12-month contracts. We don't tend to recommend to the retailers what term to price for, unless the client really has a strong opinion that they only want to do a 12-month or only want to do a 24-month term. We tend to let the retailers price for what fits their portfolio best, and then we'd go back to them and we'd discuss to them what term the client's actually after. One way of avoiding having all your load come up at the same time is what we've done for this client here. It's actually a real client, and hopefully I've hidden enough information, which is a splitting out of their contract term. Now this client's particularly large. They're around 25 megawatts in total load. They're nationwide, and we've split their contracts into 4 parcels. We run 2 parcels at the same time. Very simplistically, this is 1/3 of their load every year on a 3-year rolling contract. And we've done that so that if the market goes up, as it has now, only 1/3 of the load is impacted. The flip side is that if the market falls, only 1/3 comes up, but there is the option to do what's called a blend and extend. So going, as we are at the moment for some clients with the market falling, seeing if we can't negotiate some better rates for the final 12 months of the contract. The difference between, or knowing when to split your contracts and when not to, is probably the size of the customer. Margins vary, probably around $25 a megawatt between a 200,000 unit customer and a 40 gig customer. We tend to find above 40 gigs to 100 gigs, there's not really a big difference in the price they actually pay. The margins are a minimal amount compared to the actual cost of the energy. And then once they're over 100 gig, we have found some experiences where the prices start increasing. So for clients between 20 and 60 gig, there is generally a conversation about their risk appetite and how they time the market. If they're doing the whole lot at once, we will be monitoring the market probably 12 months ahead for them, although we may not actually go to the market until later in the period. But if they've actually split the contract, that gives us a little bit more security about what they're actually doing and when those contracts are actually going to come up. Contract type is quite a big thing, and this goes to one of the questions is, can you purchase on spot? Everyone purchases on spot, or every retailers purchase your load on spot for every single client. And what their job is to do is to give you a fixed price for which removes you from that volatility and cost. Spot is very volatile. I'll show you a graph shortly about how volatile it is. But anyone actually considering going on spot should consider what spot can do during a security of supply issue, which is when there's a shortage of electricity. Really the only methodology the retailers or generators have to hold back water or hold back supplies to put the spot prices up. And there's no limit to what those spot prices can go to. And as you saw in the yearly contract in the previous slide, it went to 19 cents for a year, and that jumped from 7 cents only a few months earlier. So it does go up, and it goes up pretty quick. To offset that spot supply, you can either take a financial contract or a fixed price variable volume. The financial contracts come in various forms, CFDs and futures. On the Electricity Authority website about purchasing in contracts, they say that CFDs are similar to futures. They are, in that if you're just looking at one number for a 12-month period, it might be the same number, but they work incredibly differently. A CFD will settle on the 20th of the month, and you transact it with the retailer, and whatever power you use, you pay for that month. With a futures contract, you're basically settling the entire year's worth of power. And if that underlying contract moves, you will then have to pay the difference between what you contracted at the start versus the movement times the total volume of your load. So you can understand that within a brief period of time, you could pay, if the market moves $10 and you're using a gig, you would pay $10 times a gig for that change in price, on top of the fact that you're actually paying prices each month. For those who need that actually explained to them in diagrams, please give me a call. The collars and caps are financial. A collar just has a maximum price you pay up to and a floor price you pay down to. So if the spot market goes below that, you top it up. If the spot market goes above the cap, the retailer will pay you some money to offset that cost. Most of these things, or all of these things, should only be recommended to you by people that are financial advisors or registered as financial advisors. And just to clarify, those that in the industry are registered as financial advisors, they are registered to provide advice to corporates who deal in foreign exchange or large entities. We're not a registered financial provider of services, so I can't talk about it to a residential person, and nor would I. But it assumes some level of understanding from the customer about how financial contracts work. The other one I have in there is financial transmission rights. So you can actually buy your load contract for a price at a certain point, and then through a financial transmission contract, have that price shifted somewhere in the country. Goes into quite a bit of depth about why there's all the different GXPs and what the price differential is between those GXPs, and again is for very informed and possibly only for industry players, but it is something that the industry guys will use. The most common is fixed price variable volume, which is what probably most people on this call are actually paying for their power bill at the moment. It basically just says this is the price at this particular time, and you can use as much as you want. Hence the word fixed price variable volume. There are some contracts that have fixed price fixed volume, which means that you pay that price for that amount of power up to the amount you nominated, and then you pay the rest on spot. So you can have a mixture of contracts with spot exposure. You can be full spot exposure. You can trade different things. The sustainability guys are probably very interested in the power purchase agreements, where you have the ability to actually go and transact with someone who's building some generation somewhere, and they may be building at the moment a solar farm or a wind farm, and they may come to you and say, would you like to own part of it, or would you like to buy the output of some of it? If you'd like to own some of it, you just take the view that you're better at generating electricity than the generators are. And if you want to purchase it for a period of time, you're generally contemplating longer term contracts at fixed prices. Both from a procurement aspect have their strengths and weaknesses. I guess really the difference is if you're doing this to beat the market, the more power purchase agreements or the more solar or on-site generation there is, in theory that takes demand away and increases supply, so that should produce a lower price in the market, and that's certainly what Australia has experienced. But for those who want to link it to sustainability or those kind of aspects, there certainly are drivers within the market which creates the market really, that says some people want to lock in their costs for a long period of time and say that they're doing something that benefits their supply chain and reduces their carbon emissions.
Now we do have a question, Shaun, sorry, we do have a question on PPAs from Michael. So Michael, I'm just about to unmute you and you should be able to get through to us with your question now.
Yeah, thanks very much, Mike and Shaun. Yeah, Shaun, I just had a quick question for you just regarding PPAs. If you have a PPA, I'm curious to know whether that entitles you as the consumer to use a lower emissions factor for calculating greenhouse gas emissions, say for corporate reporting and so on, if the generation is 100% renewable.
Yep. Perfectly honestly, I don't know. There is certainly a good argument that you have sourced electricity and you're paying for it from a low carbon emitting aspect, and that would certainly play very well in your self-reporting and on any advertising material you used. In terms of the government, the carbon costs are actually hidden in the spot prices. And I'm not sure where it is in this presentation, but I've got a little note to mention that when we talk to our overseas clients, part of what we actually say is that the emissions trading scheme costs are buried in the spot prices, and that anything you buy on spot will have a carbon cost to it. And so if you have a power purchase agreement, you will purchase on the spot and you'll offset that with whatever the agreement is for the power purchase. So it removes the cost. The generation itself, let's assume that it's green certified, so it's got a certification thing around it, and that is something that's actually being built in the market at the moment, and retailers are looking at it. But from a reporting aspect, my knowledge is the government says that you should use the average emissions factor for New Zealand. So if you have solar on the roof of your building, you will certainly be reporting less carbon because your meter will be recording less usage through it, and you could therefore say that you have lower carbon emissions. But if that power purchase agreement is with someone building a solar farm down the road, then your meter to the building will be capturing the carbon that's being produced by the industry. And the government's view at the moment is that you should use the industry specified average, which is why, for instance, South Island customers fundamentally have a carbon cost in their spot prices, because the spot market includes it, even though 99.9% of the power in the South Island will be generated from hydro and to some degree a bit of wind. So yeah, probably at the moment, no. Is it coming? Possibly. But if you put it on your roof, certainly you'd be able to benefit from that.
Thank you.
I'm not actually sure. So hopefully that answers your question. One of the things I had in there was around the spot and volatility. Why would you actually take a contract? This here is the demand-weighted spot prices, again, Electricity Authority, EMA website, from 2008 up till now. And the two spikes, one is 2008 and one is the one on the right-hand side is October, I believe, 2018. The solid lines through the middle are the average for each year. So you can actually see 2019 was the second highest price on average for anybody on spot who was screaming about that at a particular time. You probably only screamed, you were the second loudest scream after 2008. You can also see that the lowest price is 2009, 2016. So there's no real correlation at the moment between increasing demand or generation and rising spot prices. It is a reflection of, well, in 2008, a lack of water, and in 2018, a lack of gas. So when our generation options are reduced, our prices go through the roof. Those of you who can recall the gas graph right at the front, right at the start of the slides, will recall that 2019 or 2018, at the end of it, in 2019, had the highest gas prices as well. So people that were burning electricity and gas got hit by both sides. But it just gives you an idea of the volatility that can occur. So when you're discussing spot with anybody, you need to be discussing their cash flow implications, their ability to avoid those prices, those kind of aspects. As well as picking the term, and as well as picking when to go to the market, you want to pick the retailer. Most people, when they come to talking to retailers, would tell me that the both the electricity, natural gas, and LPG markets, it's a commodity, it's the same product, it turns up the same way. There are, however, service offerings that retailers need to take into account and that you need to take into account too. Probably the first one for the minimum service offerings that customers expect. So if any retailers are listening to this, you need to be able to do it and not necessarily crow about how good it is. Account managers need to be able to resolve issues. Flexibility in retailers' positions with customers is paramount in terms of anything we are recommending, but certainly just the ability of the account manager to be reachable and to give some assurance that your invoice is going to be corrected, or you can open and close an account, or your power is off and when it's going to come back on. So just that communication is probably the first one. The second one on minimum services is accurate billing. It's kind of a given. The customers expect it, not always delivered. Online access to invoices and and the ability to send invoices to head office or to multiple sites is something that customers expect, and free access to the metering data. And I know a lot of contracts were changed to say that the retailer owns the metering data, in which case I have argued that perhaps the customer shouldn't pay for it anymore. But customers do pay for the metering assets and they do pay for the reconciliation services. So therefore, retailers should be able to provide information, especially given the sustainability aspect that the economy is going through, that people are pushing the need for that information to be timely and to help inform the decisions that people are making about when to turn things on and off and how to use it. Certainly from a retailer preference, the value adds, the three I have really are the solar proposals, which clients love if the retailer pays for it. The demand management side, the ability to turn off cooling loads or heating loads, something with energy that can be sustained for a period of time. Again, customers are very interested if the retailers will do that for no cost and the customers get paid for providing the service. And sub-metering data is something that's certainly growing as well. And again, customers are interested in having it when the retailer provides it for free. I did say at the start that procurement's a lot about how much people pay for things. And I think you could probably see that a lot of the things we see get off the ground are ones that the retailers are giving away or bundling into the cost some way that the customer pays for it over a period of time. Terms and conditions, certainly something that needs to be reviewed. Most customers will want to go through the terms and conditions. They'll look at the liability clauses and argue about why the liability amount is so little from the retailer to them. They'll want to know about credit checks and bonds, which retailers tend to make the offer, sign all the contracts, and then come back and ask for the financial records of the customer. So certainly getting them beforehand is important. Payment terms, the statement 20th of the month following is confusing. Customers tend to think that's the 20th of the month after they got the invoice, whereas retailers believe it's the 20th of the month after they gave the electricity. So they bill you somewhere around the 5th and they expect payment 14 to 21 days later. We haven't as yet, well, with the exception of 1 or 2 very extreme cases, we haven't as yet got payment terms extended beyond the month following the load. And I'm happy to discuss in another forum why the retailers stick to getting paid around that. Planned outage notifications, customers generally are upset as to why they only get 4 to 5 days notice of a planned outage for something that was probably planned months ahead. It is what it is what I can say at the moment, but certainly it's something we've pushed back on retailers who defend the networks to say that this is what the network provides and the network provides it to all retailers, so it's the same. That is very annoying because the only way we can talk to networks is via the retailers. So retailers, please tell network companies about outages being notified much earlier. And early termination fees. I covered off a lot of things actually in there, and I'm just conscious of time, but the reports that we would actually give to customers would cover all those aspects. When to go to market, the contracting type that's available, flexibility around spot prices, and the retailer preferences. And having done all that, out of the thousands of reports we've produced, probably 955% of them, the client just turns back to the page that's got the numbers on it and goes, what am I going to pay and what am I going to put up with? And that's fundamentally how you get value. If the amount is significant to them, they will choose the lowest cost. If the amount is similar between 2 suppliers, they at the moment will generally choose the retailer that presents the sustainable argument the best. And that sustainability could be we are sustainable. We are 100% generation from sustainable sources. And the other argument could be we are transitioning from gas and coal to sustainable sources, so you should buy with us because we're the ones actually taking the gas and coal out of the market. Both are very valid arguments. Depends on which side you want to fall on, those that have already jumped or those that are jumping. The procurement activity, and I will try and get through this reasonably quickly just in terms of time, but fundamentally, after we've had that first conversation with the customer about their contract coming up in 6 months, we then get them, they sign a proposal with us, and we get a letter of authority, which enables us to go gather metering data and a recent invoice and copy of the contract and those kind of things. All retailers require any consultant requesting information to have a letter of authority, which just basically absolves the retailer and says, you signed it, so they saying they could have access to your information. The first things we kind of grab is the most recent 12 months usage and a copy of an invoice and a copy of the contract. The reason for that is what we're actually looking in the consumption part is how flat their load is across the year and whether or not it's a 7-day operation or a 5-day operation. Some of the simple things we'll grab out of that contract is their base load usage at nighttime on the weekend. And then we'll compare that to the half-hourly data and see how much that actually goes up and down during the course of the year. That just gives us an indication that what's running when they're not supposed to be in business. So why are they using power when in theory they think they're closed? And that picks up a lot of things like air conditioning loads and lighting loads in terms of that information. So that's one thing that actually picks it up. And for some customers who are retail orientated, they're very surprised to find that their consumption is flat across the whole week until they realize that they leave the lights on 24/7 or they leave the air conditioning load going 24/7. So at a very simple level, that will give you some information on the electricity side of things. From a gas side of things, one of the things we'll actually look at in terms of the invoice is their total usage for the month, or divide it by the number of days of operation and see how that lines up with their capacity reservation or their MDQ. So they're just some very basic looks at the demand that they're actually got. And within the half-hourly information, you'll pick up some peak load and some other information about that. That will give you some ability to actually say, what can you shift, what can you alter in terms of your production that will help the retailer give you a better price or a lower price. The procurement action itself, we issue it to market. We issue it to every single supplier and every single retailer in the market. We have no preference for a particular retailer. We charge a flat fee to our clients, and the clients can choose any retailer they like. In terms of actually issuing it out, when I worked for a retail company, generally they just wanted to know the load profile and the client name, and they can find out the rest of the things via either Googling them or going to the company's office. I wouldn't overly complicate the RFP activity. Generally, the retailers will respond with price, and if you're interested, then they'll come back and talk to you about terms and conditions and supply and arrangements like that. Telling them that you're interested in sustainability needs to be backed up by actually choosing someone that you define what that sustainable aspect is. Saying that you're interested in demand management or the ability to interrupt supply or load, will encourage some, but there are third parties that will actually go out and do that as well. So bundling it in with your electricity retailer, then if you ever change that electricity retailer, the question is what did that change about your preferences for who you're looking for? And we generally will actually tell you what the billing types and templates and payment terms are in terms of the report, but certainly once you've actually got offers in is generally when we would go back and start discussing the conditions of supply. I just think it works better. Certainly if you're dealing with government agencies, you need to discuss all these things up front, so you spend a lot of time negotiating with everybody what terms and conditions they will use and how interested they are in terms of supplying you as a customer. Check the first invoice is something that happens at the end of the procurement action. I should actually, just before I get to check the first invoice, just before it's signed, reviewing terms and conditions, it's not something we are actually allowed to do. The lawyers ganged up on us and said they don't do energy procurement and we're not allowed to give advice on terms and conditions. As industry experts, anything we actually say about the terms and conditions can be deemed to be an interpretation of them. So whilst we will highlight the clauses that we think people are interested in and where to find them, it's generally up to the customer's lawyers to talk to the retailer's lawyers about changing any of them or how they're interpreted. Details to check on the invoices, apart from the actual energy usage. Here's just a couple of examples. You'll check the network capacity, and those of you that are quick at maths and can divide the quantity by the number of days on the bill will come up with 1500 kVA. So they're using half their capacity, so that could be something to look at. Probably the first thing I'd look at in that top left-hand corner is the power factor penalty charge. It appears on so many invoices, it's not funny. The other one is the metering fee, and this particular client has 2 metering fees for 1 ICP, so not uncommon, but a little bit different to what we'd actually normally expect. And then on the gas side of things, you're looking at transmission, vector charges, capacity overruns, total energy overruns. So are they using more than they thought, and are they paying penalty fees for it? Those are generally just the things we get off the invoice, but the other thing we use off the invoice is we check the invoice against the contract rate and just make sure it's being applied correctly. So at least that's one check when we actually do a comparison on the financial summary between what they're paying now and what all the offers are. And also we do a comparison to what the potential spot prices would be, and we use 2016 and 2019 for those years being the lowest and highest. And we think that gives them pretty much everything they need to know in terms of whether or not to contract, what term to contract for, and in terms of the report, who all the retailers are in terms of the sustainability. I've covered off a lot of the energy side. for these things, but one of the other aspects to cover off is the network costs. They do tend to make up 30% of the bill for electricity and natural gas. One of the things to look at is optimizing the capacity charges, and it does make a difference if they've got a dedicated transformer or if they're actually just a shared transformer. It's quite hard to change the capacity when you own the equipment, or sorry, the equipment's provided solely for you. But if it's a shared transformer, then it can be as simple as changing a fuse. Definitely look at the power factor penalties. Because it's a penalty charge, it's outside the price path for network companies, who conveniently, when they implemented it, described it as the business case would pay for itself, which was a very nice way of saying it's going to be expensive. And just also covering off any excess demand charges for the high voltage or anything over the maximum daily quantity for gas. And the final one around the demand charge would be coincident peak demands. That's where the customer's peak demand coincides with the network peak demand, and the conversations with them should be, can they shift it, can they alter it around? The network costs for non-time use billing, they used to be called non-half hour and half hour meters. With the introduction of smart meters, I think that flippancy around the naming convention becomes confusing. So we tend to refer to it as they're either billed on a time of use meter or not built, or non-billed on a time of use meter. The non-time use, it's quite important to get the load groups right. Load groups are the network charges, and they vary for different types of customers and different loads and capacities. And sometimes just a simple change in there can save a client 10 or 15%. And with the new smart meters, the ability to go onto a smart meter based tariff, with base load for petrol stations or pumps or irrigation with the summer load, can certainly save them money. And it was covered off a little bit last week in terms of presentation, the difference between non-time use billing and time use billing. When should you be on one or the other? It varies by network, and effectively it just needs to be evaluated. A change is actually reasonably annoying, so it's not something you change on a regular basis. And anyone between 200 and 500,000 units probably should be considering it. Anyone under 200,000 units should be on the non-time use billing, although the smart meters would be included in that, so they may go down to just a simple two-part tariff. For natural gas, the split there is anything over 10,000 gigajoules has to be on an hourly meter or a daily read meter. And for LPG, certainly have a preference for those that are supplied by truck and filled up on site, and they generally pay by the litre. Those doing bottle exchanges, it ends up with credits and debits. So if they take away a half full bottle, they will credit your next invoice with half that LPG and charge you for the next one. Yeah, as you could expect, it's prone to errors, and so billing by litres on LPG is probably our preference. Final thoughts on that. We do get asked what's the best processes of a request for quotes or request for tender or an RFP. I don't get tied up too much with actually giving it a label. We issue our RFPs on the basis that the winning proposal may not be the lowest price and the client may decline all offers. Fundamentally, whilst price is important, clients are starting to look more at the sustainability aspect. They're starting to look at more at the additional services retailers can provide, but they are also looking at different terms and how that fits in with them and their risk profile. So the cheapest 12-month price may get beaten by a slightly more expensive 3-year price, that kind of thing. When markets are stressed, prices you may have to request multiple times. So retailers are very quick to put their prices up, and we've had periods where we've had 2 or 3 re-offers from retailers in the space of a week. At the moment, the prices are coming down, so certainly we would be running these activities. We would ask for a price, we'd give the recommendation, we'd give the report and discuss it with the client. And then as the market's fallen, we've gone out and asked for a price again, gone out and asked for a price again. The report should cover the total cost of energy, and it should be able to be updated with revised offers. We are about getting the best deal we can for our clients. So that's the right product, the right supplier at the lowest cost for the least risk. And And I'll finish probably just discussing our procurement fee. I debated a little bit whether or not to actually just put the number on the board, but to give you an idea, for a single site, we'd probably be looking around $1,000, and that customer may choose a 3-year contract. And if you use a benchmark that procurement fee should be 1% of the cost, then that means someone spending $33,000 per annum over 3 years would probably benefit from our services. We certainly target those spending more than $100,000 though. And probably our fee maxes out around the $20,000 mark, and that would be an unlimited number of ICPs nationwide. And as I said, we already run the procurement process multiple times. So procurement shouldn't be expensive. It's fundamentally a process and a task. You pay us for our knowledge. We know the market. We know when to go to market. We should be able to provide you answers to every single question you have, because we've done it for, well, in my case, over 20 years. And so that the point of the procurement is to effectively pay us for our time and reimburse us a little bit for our knowledge, and the customer benefits from that service. We have done percentage savings once, but it's given if you tell me the retailer and the time you signed the contract, I can pretty much tell you what your price you're paying. So I already know what the savings are probably going to be. And if there aren't savings, which whilst the prices have fallen at the moment, fundamentally electricity costs are still higher and gas costs are still higher, I probably wouldn't do a percentage savings proposal. Hopefully in a very quick period of time, I think I spoke for about 50 odd minutes, you've got a rough idea of the strategy and the process for doing the procurement. We do this for a number of other consultancies, so we don't just do it for ourselves, we do it for other energy efficiency companies, we do it for other procurement companies actually, who will actually be pitching for business. So if you are interested in having that conversation with us, please do so. If you do procurement for someone and you just need a little bit of support for it, we will bundle it in your letterhead and provide an end-to-end service for your clients. So yeah, give us a call. That, I believe, Mike, if you're still listening, will be time for any more questions.
Actually, still listening, still riveted, Shaun. That was really quite interesting for me. Still picking up some of the nuances of procurement and the markets. So I found that very interesting. And you've already called for questions, so I'm watching out for anything that might come in. We don't have any questions just yet. We need to allow a little bit of time for typing speeds in case people are.
Yeah, try to finish within the hour. In terms of spot, feel free to, as I said, feel free to give me a call or just ring your retailer about it. But you certainly want to cover off the cash flow implications and your ability to respond. Fundamentally, price should be a signal as to whether or not you want to use it or want to avoid using it. So your ability to interrupt demand would be something I'd certainly consider with spot.
I still don't see any questions coming in, Shaun, which means a couple of things. Means we dealt quite adequately with the couple of questions that we did have during the session. And it also means you've obviously explained everything incredibly well. And nobody wants to follow up with any questions. So I'm not seeing any. So what I'll do is say thank you very much on behalf of the audience, a good audience today. So thanks for that. Thanks for sharing that knowledge. And if anybody does have any subsequent or follow-on questions, then by all means send them through to me or directly to Shaun. Easy enough to contact, I would suggest, Shaun, for questions like that. And hopefully,
telephone numbers on the front slide.
Yep. Hopefully you've all learned a little bit today. And if we learn a little bit every day, then we're doing well. Just one final thing before I go. Next week, of course, we have another session. Next week, we're going to be joined by Jack Young of Energy NZ. And Jack's going to be talking to us about industrial heat pumps. We hear a lot in the news these days about industrial heat pumps and whether they're a silver bullet for some of our carbon emissions problems, or whether or not there's a lot of hype around them. So Jack will be investigating and talking to us about the applications of industrial heat pumps and the effective applications, where they should be used, when they should be used, and whether or not they're good investments for people. So on that, thank you all very much, presenters and attendees, and we'll see you all next week. Thank you and have a good evening.
See you, Mike.